Bullseye Brief. Adam, thanks very much for joining us. Of course, it's always hard to pick market bottoms, notoriously, but you think that there's compelling reasons to load up on stocks right now?
Well, despite the headlines, Andrew, there is far more to like than to fear. We have an economy that's growing. We have earnings that are rising 12%. We also have profit margins that have expanded to 13%. That's the strongest combo, 12 and 13, that we've seen since 2001. So corporate America is doing just fine. Our economy is doing fine. I know tariffs, very messy. Inflation is still a little higher than we'd like, but when you look at the big picture, there's so much more to like than to fear. And as far as why I think this current pullback is a time to come in and buy, Andrew, over the past 3 years, there have been 9 previous declines for the Nasdaq, which exceeded 10%. The average pullback was 14%. And each of those 9 times proved to be an excellent buying opportunity. The current pullback, as you have been talking about this morning, is 14%. So it's not like this is anything new. In fact, I'll even go out on a limb and tell you, Andrew, this is probably the first of 3 pullbacks we'll see this year, because that's just what markets do. Pullbacks, or drawdowns, if you want to use a more onerous word, are always uncomfortable, but they generally are opportunities for thoughtful long-term investors like you and me, and I imagine a lot of our viewers, like for all of us to come in and buy high-quality companies with cash flow and visibility and unique products. So I'm a buyer.
There's speculation now that the Fed will, in fact, cut interest rates twice in 2025. Is that a factor you take into account?
No, no, it doesn't. And I tell you why. And I may be in the minority on that particular issue. I'm buying stocks because of earnings growth, not because of rate cuts. In fact, if you're buying stocks because of rate cuts, what you're really saying is you're looking for a sugar high. You don't like the substance of the thing itself. It's like people who drink coffee. Okay, some will take it black, others, load it up with cream and sugar.
Oh, yeah.
Which is it you prefer, the coffee or the cream and sugar? I like the coffee. I like substance. I like earnings growth. I like cash flow. I like exciting companies. I run the American Ingenuity Fund, right? The people, companies, and technologies driving this world forward. I do have a couple Canadian companies in there, Celestica as an example. So I think maybe we should call it the North American Ingenuity Fund. But that's why I'm buying. It's technologies, growth, and people making a difference. It's not rate cuts.
Celestica, obviously, it has been something of a market darling. People hope that it'll get massive business supplying equipment for data centers, but it sure has slid from its high, Adam.
Oh, I know, and that's why I'm buying it. I mean, Celestica at this point is trading at probably 14 or 15 times earnings, and yet the growth is arguably going to be 30 or 35%. So you can buy the S&P 500 at 20 times earnings and get 12% growth, or you can buy Celestica at 15 times earnings and get 30% growth. So for me, the choice is clear. I would much rather bet on Celestica, and quite frankly, any number of AI stocks that are down so much right now, from Sterling Infrastructure, STRL, that builds data centers, to GE Vernova, the spinoff of the old GE division that turns natural gas into electricity with on-site generators. They power data centers. NVIDIA, at one point, Andrew, NVIDIA at the low a couple days ago was trading cheaper than the S&P 500. The AI darling of them all, NVIDIA, which is growing 75%, was trading at 20 times earnings, and the S&P 500 at that moment was trading at 20.5 times earnings. There is a lot of devastation out there. A lot of stocks have just been way oversold. I'm talking about AI stocks right now, but frankly, we could broaden the conversation. I feel like you could buy almost anything right now, and 6 months from now, you'll have made money on it.
Supermicro computer, you like the look of this one, and of course they're a big player in server building, but they did have that accounting, questions about their accounting hanging over them. Does that not turn you off?
The operative word in the sentence you just said was did. They did have accounting concerns around the company by a company a short-selling company called Hindenburg Research that has since closed its doors. Hindenburg is no longer in business. And I should point out that the company is no longer the subject of any scrutiny over its accounting practices. A third-party entity investigated the company, found that there was no wrongdoing, that the Hindenburg Research report claiming or alleging accounting irregularities was inaccurate. So the company has been exonerated, management has been exonerated, the board has been exonerated. In addition, the CEO has guided to 60% earnings growth this year, accelerating to 65 to 70% next year, and shares like Celestica trade around 15 times earnings. So it's the same price as Celestica with actually twice the growth. So yeah, there's another one I want to own, and I'm not at all worried about the has-been of alleged accounting irregularities.
Adam,